Bitcoin is doing exactly what it's designed to do: shake out the weak hands while setting the stage for the next big move. It goes quiet, dips just enough to test conviction, and suddenly the market splits. One camp panics, seeing the beginning of the end. The other sees the opportunity, and the truth is, Bitcoin has always rewarded those who think long-term. Right now, that divide is sharper than ever, because even the biggest voices in crypto are interpreting the same price action in completely different ways. At the center of this conversation is Raoul, who makes it clear: Bitcoin's recent pullback isn't failure, exhaustion, or a broken cycle. It's a phase 2 correction, a healthy reset inside a much larger bull market. And that's exactly what makes Bitcoin so powerful. Corrections aren't a warning, they're part of the game. Understanding them is how you position yourself to benefit from the unstoppable momentum of the world's most resilient digital asset.
We are now still in the early phase of phase 2. This is not a phase 2 correction. We've barely broken out. In fact, most other assets, thinking about stuff like total market cap, X, Bitcoin, and ETH, haven't yet broken. Now think of the banana zone here. All of these previous 3 were all only one period wide, this 1 year. This one will be wider. So which is why the market looks less parabolic at this stage. But the parabola will occur, and Julian showed you with that work earlier, and we will have a phase 2 correction.
Pal's confidence does not come from charts, halving schedules, or familiar crypto folklore. His framework is rooted in global liquidity. He argues that Bitcoin no longer trades like a niche technology asset or a speculative toy, but more like a macro-sensitive instrument that responds directly to the expansion and contraction of money itself. When liquidity tightens, Bitcoin struggles. When liquidity expands, Bitcoin runs. From that perspective, price is not leading the story. Policy is. According to Pal, the conditions that matter most are lining up just ahead: fiscal stimulus, regulatory-driven money creation, changes in bank leverage rules, and a weakening dollar all point toward a meaningful shift in liquidity as 2026 approaches. He believes those forces could begin activating as early as January, setting the stage for what he describes as a liquidity-driven expansion rather than a speculative mania. In that framework, the halving narrative becomes secondary, almost decorative. Liquidity, not mythology, becomes the engine. While Pal is zoomed out, Samson Mow is looking directly at the market's strange behavior in the aftermath of the halving. Bitcoin, instead of exploding upward as many expected, seemed to lose its volatility. Price chopped sideways. Large liquidations occurred, yet Bitcoin barely flinched while altcoins collapsed. To Mao, this was not weakness, it was resilience. He described the recent sell-off as one of the largest liquidation flushes in Bitcoin's history, yet the asset itself absorbed the shock with surprising stability. Altcoins, by contrast, were devastated. That divergence matters. It suggests that structural demand for Bitcoin is stronger than it appears on the surface, even when price refuses to reflect it immediately. Mao does not offer a single clean explanation for why Bitcoin stalled in 2025. Instead, he lists possibilities: paper Bitcoin, exchange behavior, whale rotations, ETF flows, profit-taking, and post-halving repositioning. The point is not certainty. The point is constraint. Bitcoin's supply is finite, and accumulation at current prices by large players cannot continue indefinitely without forcing repricing.
But you can see, like, the volatility has declined a lot. Like, I think that was the largest flush ever of liquidations. That largest flush ever of liquidations, and all we did was drop 20. Altcoins dropped, down
like
to the
90%.
depths of hell.
Yeah.
But, Bitcoin largely unaffected. And it goes to show, like, the resilience is there. It's just there are factors that will push us down or keep us down. You can theorize about many things, but maybe it's not one answer. It's many different things. Maybe there is an exchange selling Bitcoin that they don't have, like FTX did. Maybe it is some paper Bitcoin. Maybe it's whales rotating. Maybe it's people moving into ETFs. I don't know. Maybe there's people taking profits. All of these things can be possible. We don't know. But what we do know is there is a limit. And what we do know is it's impossible that, Michael Saylor gets 10% of the supply. At these levels, he's going to get 10%. Like, that's just ridiculous. So the price has to move sooner or later. And I think it's going to be sooner. The other thing probably is like alts were running too hot. Ethereum was like, getting past its all-time highs. Ripple is at like $3.50, which is ridiculous. And I think when alts run too high, there's always a correction. And I've after our Volcano interview, I kind of flipped bearish because the alts were running, and we just know like that is unsustainable. And when they go, Bitcoin always will follow down a bit, but then we kind of shake them off and we go back up.
That is why Mao repeatedly emphasizes time rather than timing. He argues that it is mathematically implausible for major entities to continue absorbing supply without the market eventually responding. In his mind, Bitcoin has not failed to move. It has been compressed, coiled, and restrained by structural forces that cannot hold forever. That long-term thinking also shows up in how Mao frames his own legacy. He speaks less about short-term price and more about the transition from a fiat world to a Bitcoin world, and whether that transition unfolds smoothly or chaotically. His focus on Bitcoin bonds and sovereign adoption places him firmly in the camp of people thinking in decades and centuries, not quarters. A similar long-horizon perspective comes from Brian Armstrong, who has been clear that Bitcoin's story is far from complete. Armstrong's argument is deceptively simple. There will never be more than 21 million Bitcoin, and vast pools of global capital still do not have access to it. From that alone, he concludes that Bitcoin still has a long way to run.
We also saw the United States of America now has a strategic Bitcoin reserve. So if the United States government is going to begin holding Bitcoin, I think that's going to be a massive driver of demand, and the rest of the G20 countries will probably follow suit. And then the last thing I'd say is that we saw recently the launch of the Bitcoin ETFs by a number of different firms, and Coinbase is actually powering 80% of the custody for those that are out there. But we're seeing a ton of institutional money continue to flow into Bitcoin now that these ETFs are live. So there's a lot of positive tailwinds for Bitcoin, and I think that there's never going to be more than 21 million Bitcoin ever made in the world, and lots of pools of capital still haven't gotten access to it. So that tells me this thing has a long way to run.
This is not a price prediction. It is an access argument. Pension funds, sovereign wealth funds, insurance companies, and large institutional portfolios control tens of trillions of dollars. Yet only a fraction of that capital can currently touch Bitcoin due to regulatory, operational, and compliance constraints. Even modest allocation shifts, Armstrong notes, could translate into enormous inflows. As the CEO of Coinbase, Armstrong has a front-row seat to how institutions interact with crypto infrastructure. His view is that the bottleneck is not technology, it is regulation and access. As those barriers gradually erode, the demand side of Bitcoin's equation may look very different from what markets are currently pricing in. If Armstrong is describing the present constraint, Adam Back is describing the extreme endpoint. Back has suggested that Bitcoin could one day reach a $200 trillion market capitalization, a figure that sounds absurd until you understand the premise behind it. He is not forecasting a speculative bubble. He is imagining a world in which Bitcoin functions as a global reserve asset, absorbing value currently stored in fiat systems, sovereign debt, and traditional stores of value. Adam Back's thesis rests on the same foundations as Armstrong's and Powell's: fixed supply, rising institutional adoption, and systemic distrust in fiat expansion. He frames Bitcoin as an arbitrage opportunity between what the current monetary system is producing and what a hard, verifiable digital asset represents. In that world, companies that adopt Bitcoin early on their balance sheets are not speculating. They are front-running a monetary transition.
What does full adoption look like? So I think the one target is gold. And, gold values are quite high at the moment because of the macro hedge phenomena where governments will buy gold in times of uncertainty. And so, but even there, with the current Bitcoin price level, it's within about a factor of 9 of reaching the gold market cap. And then the larger addressable market for monetary premiums in different assets, like housing, there's a lot of monetary premium there where people will buy an apartment and not use it, not even rent it out, just as an investment vehicle, right? So you see a lot of underused housing premium in the housing sector in different countries, and obviously premium in shares in the stock markets and bonds and other forms of alternative assets and say, how Finney actually estimated that to be 200 trillion. And surprisingly, he did this in I think 10th of January 2009, before there were any transactions in any market value. So it's quite a kind of forward-looking estimate, but it seems to be still, considered a reasonable estimate of the size of that addressable market. Now, we don't know, how much of that Bitcoin will capture. So there's a bit of conjecture there, but it seems logical that, if the institutional adoption continues and the retail interest continues, that Bitcoin could get there.
That argument is reinforced by the actions of Michael Saylor, whose aggressive accumulation strategy has made him one of Bitcoin's most polarizing figures. Saylor's belief that Bitcoin belongs on corporate balance sheets as a treasury asset aligns closely with Bakkt's vision. These patterns are most obvious during market pullbacks. Large on-chain movements often make headlines, and without full context, observers can jump to conclusions. For example, recent reports showed BlackRock transferring significant amounts of Bitcoin and Ethereum to Coinbase. Some interpreted this as massive selling, while others saw it as routine internal custody operations or ETF-related settlement flows. In reality, much of this activity is routine. Billions of dollars of crypto moving between exchanges, market makers, and institutional wallets often reflect predictable events like ETF redemptions, options expiries, or year-end portfolio adjustments. For long-term investors, these moments aren't a sign of weakness. They're a natural part of Bitcoin's market mechanics. Misunderstandings and headlines may create temporary fear, but they also highlight the growing sophistication and institutional adoption in the Bitcoin ecosystem, offering patient investors an opportunity to reinforce conviction. Yet beneath the noise, researchers pointed to something else entirely. Volatility was shrinking, options positioning was tightening, price was moving sideways, frustrating both bulls and bears. Historically, these conditions often precede inflection points rather than breakdowns. Compression, not collapse, became the quieter interpretation. Meanwhile, macro indicators are sending bullish signals. Analysts tracking yield patterns between US and Chinese bonds have identified technical cues that historically have preceded Bitcoin bull runs, suggesting the next major uptrend could be on the horizon. Momentum indicators showed similarities to earlier accumulation phases, particularly the period leading into Bitcoin's explosive multi-year advance following 2012 to 2015. None of these signals guarantee outcomes, but together they suggest a market that may be building rather than breaking. What emerges from all of this is not a single narrative, but a hierarchy of perspectives. Some voices are focused on liquidity and macro cycles. Others are focused on supply constraints and structural demand. Others still are reacting to visible flows and short-term price damage. All of them are describing different layers of the same system. Bitcoin is no longer driven by a single catalyst, cycle, or calendar event. It now moves within the same macro forces that shape global capital flows, risk appetite, and the fragilities of fiat systems. In that environment, corrections are not failures, but functional resets. The real transformation may be cognitive rather than numerical. As Bitcoin integrates deeper into global finance, it demands discipline over mythology, macro awareness over emotion, and structure over speculation. Whether 2026 delivers a full liquidity expansion remains uncertain. Policy shifts, broken correlations, and surprises are inevitable. What is clear is that Bitcoin must be analyzed as a liquidity-responsive asset, not a standalone narrative. As we wrap up, where do you think Bitcoin is headed next? Breakout or breakdown? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.